Hello, my friends, and welcome back to the second part of valuation and risk models. We're going to continue here with our bond material. So, bond pricing, discount factors, arbitrage. Of course, we have seen a lot of that already in book 3. Book 4, of course, introduces discount factors, which are intimately related to spot rates. So, a discount factor is simply the present value of $1 to be received in the future. So you could conveniently use discount factors instead of spot rates to discount cash flows and to obtain the arbitrage-free price of a bond. Here, of course, we mention the lower of one price, and we mention the fact that if the bond price is lower than what it should be, based on the spot rates or the discount factors, then we should buy the bond strip itself, the strips, thereby capturing the arbitrage. If the bond price is rich, then we should do the reverse. We should buy the strips, reconstitute the bond, and sell the rich bond. So the process of actually stripping a bond is run by the US Treasury. It's the strips program. And when they strip a bond, they would either create coupon strips, which are referred to as C strips, or principal strips, which are referred to as P strips. Okay. We also have the mathematical relationship here between a spot rate and a discount factor. But as I have explained in the tuition course, we don't actually need this formula. We could use the TVM buttons to derive one from the other. So let's start with this question here. A 2-year bond has an annual coupon of 7% and a yield of 8. 1 and 2 year zeros are yielding 4 and 8. So because these are zeros, this is essentially my 1 and 2 year spot rates. Which of the following is correct regarding an arbitrage opportunity? Okay, so we could have been given discount factors, but in this case we're given spot rates. So that's absolutely fine. Same thing, really. I'm going to price the bond. So the bond is going to pay me $7 in year 1 and $107 in year 2. Or you can think of this as percentages of par. And I'm discounting this at 4% in year 1 and 8% in year 2. These are just the spot rates. Okay, so let's start by calculating our arbitrage-free price. Remember, whenever we are discounting at spot rates, we are calculating an arbitrage-free price. Okay, so I've got 98.47. Now I'm also given the yield of the bond. So the yield is based on the actual market price of the bond, and this is going to be a TVM computation. So you've got 2 years to maturity. The yield is 8, the payment is 7, and the future value is 100. So what is the price based on this data? Okay, so I'm going to clear the memory here, second future value. So I've got 2n, 8 IY, 7 payment, 100 future value, and I'm computing the present value to get 98.22.